Cathie, the key debate on Wall Street, what everyone is discussing is the Fed going to continue hiking rates, or are they going to stop and turn around to come back down next year? What do you think?
In your view, what is the best case and worst case scenario for ARK returns over the next 5 years?
The questions of whether the Fed will keep raising interest rates through 2023 and how ARK Invest funds will perform are actually one and the same. I've already spent a lot of time over the last few months talking about why growth stocks in general, and Cathie Wood's funds specifically, are incredibly sensitive to changes in interest rates, so I won't rehash that here. Instead, what I want to do in this episode is show you Cathie Wood's latest contrarian view on inflation and interest rates, as well as what she's been buying and selling in the ARK Invest funds as a result. Your time is valuable, so let's get right into it, starting with this quick clip from Bloomberg, where Cathie Wood discusses her predictions for inflation, interest rates, and the economy. After that, we'll break down what she said together, and then take a look at her trades since the latest inflation numbers came in. Here's the clip.
Cathie, the key debate on Wall Street, what everyone is discussing is the Fed going to continue hiking rates, or are they going to stop and turn around to come back down next year? What do you think?
We think the latter. We're getting all kinds of signals that the economy is very weak. I know a lot of people are focusing on last week's big employment gain in non-farm payrolls. But if you look at household employment, which is a much broader based survey of employment, that has been flat to down for the last 4 months. And we know the Challenger survey says that layoffs are up 55 to 60% year over year. And I think this is all related to inventories. We have a massive inventory glut, but I think that
now there's
we're
an inventory
probably going to see the
headcount.
unwinding.
Yeah, Cathie,
Yep.
You said deflation is more of a concern than inflation. Do you still think that after the big prints that we've seen, and we're still expecting, for example, 8.7% headline CPI on Wednesday?
Yes, I still think that because the evidence is piling up. Now, the CPI and in some measure, the PPI, both of those are lagging indicators. The Fed is driving policy off of lagging indicators. If you look at the real inflation gauge out there, it's gold. Gold prices peaked in August of 2020, 2 years ago.
Right.
If the Fed continues to tighten, we believe the dollar will turn back up and these commodities will continue to fall.
In your view, what is the best case and worst case scenario for ARK returns over the next 5 years?
If you're talking about the backdrop, if inflation were truly embedded in the system, 70s style, that would not be a good time because interest rates probably would go up a lot. In fact, one of the really reassuring developments recently has been the drop in long-term interest rates, the 10-year Treasury. So the bond market is basically saying, no, this is a very good time for innovation. However, if it reversed and went the other way, that would be bad. If our outlook for deflation is correct, cyclical deflation and secular deflation. Secular deflation associated with technologically enabled innovations. That's a good deflation. That's not a bad deflation. If those two are correct, that would be the best environment, I think.
All right, so there are a few key points that I want to break down here. First, Cathie's view is that the Fed will stop raising interest rates sooner than later, and potentially even lower them next year. This is a very contrarian opinion. Let's take a look at the latest Fed dot plot, which shows each FOMC member's long-term prediction for the federal funds rate. According to the committee, rates should peak next year, not be on their way down. What Cathie Wood is betting on in this case is inflation data coming in way lower than expected over the next few months. She thinks that'll happen because of a number of factors, like the demand destruction caused by how much the Fed already raised interest rates, layoffs being up by more than 50% year over year, which drives down spending power, and the massive surplus of inventories that businesses will have to sell at discounted prices. Cathie Wood is claiming that all three of these are deflationary forces that will result in big downside surprises in inflation. That's what Cathie Wood is calling out at the end of the clip, when she says that if inflation was really embedded into the system, like it was in the 1970s, that would be really bad for ARK Invest, because it would force a huge long-term rise in interest rates. She just doesn't see that happening, even though we're seeing record inflation prints north of 8% almost every single month. Is this just wishful thinking on her end, or is it something else? Let me know your thoughts in the comments. I think the reason for this is that Cathie Wood is looking at leading indicators, like the price of copper and gold, while the Fed is looking at lagging indicators, like the Consumer Price Index. To Cathie, the price of gold peaked 2 years ago, but to the Fed, inflation peaked just 2 months ago at a whopping 9.1% year over year. So the real question I have is, how much do the indicators that Cathie is watching lead the indicators that the Fed is watching? For example, if there's a 2-year gap between these indicators, then a lot of Cathie's calls could eventually be right over the long term, but they're way too early to act on in the short term. In fact, just last week, the Fed reconfirmed that their top priority is still fighting inflation, which they see as still running very hot.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Our responsibility to deliver price stability is unconditional.
Jerome Powell said that he's willing to cause even more economic pain to make sure that prices level out over the long term, which means more rate hikes in the near term, not less, which will cause more layoffs in the near term, not less. So when we look at what Cathie Wood has been buying and selling, keep in mind that she's positioning ARK Invest funds for an environment that we may not even see for another 2 years or more. It all depends on what inflation data actually looks like and when interest rates will actually peak. That means there could be a lot more downside for her funds in the short term if the Fed stays on their current course. On the flip side, the stocks that she's holding now could be some of the biggest winners if the Fed surprises the stock market by changing course and hiking interest rates by a lot less than everyone expects. The Fed has definitely changed its mind before, so I wouldn't completely rule out the possibility. Alright, with all that context, let's take a look at how ARK Invest's top holdings have changed since August 10th, which is when the July inflation data came in at that 8.5%. Keep in mind that this analysis doesn't include the 3D printing ETF, ticker symbol PRNT, the Israel Innovation ETF, ticker symbol IZRL, or the now closed ARK Transparency ETF, ticker symbol CTRU or CTRU. These three funds track specific indexes and are not actively managed. So here's a table of ARK Invest's biggest position changes when you combine Cathie Wood's 6 actively managed funds. Each row is one company, the rows are ordered by the size of Cathie Wood's position in that company, and each position is colored by its change in size since the latest inflation data came out. Since then, ARK Invest's assets under management fell by $2.4 billion, or about 15%. So positions colored in green shrank by less than 15%, and positions colored in blue shrank by even more than 15% over this time frame. That means the green rows are positions that Cathie Wood increased relative to the rest of the funds after seeing the latest inflation data. Keep in mind that there are 2 ways to increase her position. She can either buy more shares, which is shown in the change in this first column, the change in shares column, or she can hold shares instead of selling them as they go up in price, which obviously grows the position size, but adds in the risk of the stock going back down as the Fed responds to new inflation data by raising interest rates. So, for example, Cathie Wood's position in Tesla shrank by 5.7%, which is a lot better than the 15% that her funds shrank by on average. The numbers look a little funky here because Tesla stock had a 3-for-1 split about a week ago, but her share count increasing by less than 200% after the 3-for-1 stock split means that she actually sold around 4% of her shares pre-split. Still, Tesla is Cathie Wood's #1 position by far, and ARK Invest's only position worth over $1 billion across our combined funds. There are two interesting things about Tesla being ARK Invest's top stock by such a large margin. First, it's in the top 5 positions of both the S&P 500 and the Nasdaq, and ARK Invest tries not to be too correlated with the other major indexes. Granted, she's been holding Tesla way longer than it's been in the indexes, but that doesn't really matter here. The second interesting detail is that she shrank many of her other top positions, but not Tesla. Most of the top stocks on this table are blue or gray, but the positions get more green the further down we go. What that means to me is that Cathie Wood is spreading out her funds right now, not concentrating them down into her highest conviction positions. That typically only happens when she expects her highest conviction stocks to go down in price in the near future. Why else sell them? These trades could be acknowledging that inflation and interest rates could come in higher than ARK Invest would like in the short term. If we sort this table by the change in share count instead, we can see which stocks Cathie Wood bought to broaden out her funds. Butterfly Networks, Adaptive Biotech, CareDx, Ginkgo Bioworks, Zoom, 908 Devices, Invitae, Schrödinger, Exact Sciences, Pacific Biosciences, Fate Therapeutics, and 10x Genomics. So, besides Zoom, she's really only been buying shares in companies that are found in ARKG, ARK Invest's fund themed around the genomic revolution. Cathie Wood was a net seller for almost every other stock on this list. We can see that the price drops are pretty varied, while the changes in share count are pretty consistent. That tells me that some of these sales are due to outflows from the ARK Invest funds, not that they've lost conviction in these stocks or that Cathie Wood thinks that there are better deals elsewhere. The only stocks that it looks like she sold for real are Insight, Signify Health, and Nvidia. Insight was probably sold because it didn't drop as much as some of her other higher conviction positions. Signify Health was probably sold because it's been on an absolute tear lately, being up by over 60% since the start of the month and up by about 150% since mid-June. And Nvidia was probably sold partly because of their warnings about a lack of GPU demand from both gamers and crypto miners, and partly because it's another top stock in the indexes that ARK Invest tries to differentiate from. But I think that selling Nvidia just because their gaming revenue had a big miss could be a pretty big mistake, and if you want to know why, check out this episode next. And if you want 24/7 access to these interactive tables for yourself, consider becoming a patron on Patreon or a channel member right here on YouTube. Either way, thanks for watching, and until next time, this is Ticker Symbol U. My name is Alex, reminding you that the best investment you can make is in you.